Hey everyone, I'm Adam Black, your lender for your life, and today we're talking about a hot topic in the home buying world right now, and that's affordability, and what I believe is a great solution for a lot of home buyers right now. Now, first of all, let's discuss the dilemma that we currently face in the United States real estate market. Rates are obviously higher, inventory is still low, and this pushes prices higher, creating a conundrum for home buyers, which is what we call affordability. Then potential home sellers are essentially locked into their sub 3% mortgage rates, even though they may want or need to move at this time. So is there a solution? Most people would think lower home prices would help. However, every $10,000 in home prices only changes your payment approximately $65. Not a big needle mover. Now, one solution that makes impact is the temporary buydown, more commonly called the 3-2-1, 2-1, or the 1-1 buydown, with the 2-1 being the most common. Now, using this strategy, homebuyers can save hundreds off their mortgage each month and thousands cumulatively. So what is a temporary buydown? As the name implies, this is a process of buying your interest rate down for a specific amount of time. Whereas with the more traditional permanent rate buydown, you're paying a fee up front at closing to buy the current market rate down to a lower rate for the life of the loan. But there are two issues with this permanent strategy. First, the amount of money needed versus the amount the rate and your payment actually drops isn't normally that impactful. Second, this fee you pay up front is a sunken cost, meaning once it's spent, it's gone. You're not getting anything back other than the difference in payment between the higher rate and the buydown rate. And in most cases, it takes you about 36 months or more to recoup that difference when you calculate the amount spent divided by the monthly savings. So let's look at an example. Let's say you're buying a house for $350,000 and you're putting 5% down on a conventional 30-year fixed rate mortgage, and today's rate is 6.75%. Now, the principal and interest payment is $2,156 on that. Let's also assume 2.25% of the loan amount, $7,500, is used to buy the rate down to 6%. That's a savings of $163 per month. Not bad, but it would take you 46 months just to recoup your original investment. Now, we can all use an extra $163 a month in our pocket, but you have to admit the savings isn't what you thought it would be considering the investment. Not to mention, should rates begin to drop as most expect, there's no benefit to you to refinance until you've recouped your original investment, or you have to accept that loss, refinance, and move on. So is there a better solution? Let's consider the temporary buydown. So as the name implies, a temporary buydown buys down your rate for a predetermined period at the beginning of your long term. This means all your savings is recognized quickly. The amount that term can be is 3, 2, or 1 year, and the amount it changes is 1% per year. For example, a 2-1 buydown buys your rate down 2% year 1 and 1% year 2, and then you go back to that original market rate. So basically, it stair steps you back to the market rate. By doing so, your monthly payment is impacted more and your recoup period is way shorter. Now let's break down how it actually works. A 2-1 buydown works off what's called a subsidy account. And this is just a fancy word that means the money used for this is set aside in an escrow account. As each monthly payment is made at the lower rate, money comes from that subsidy account to make up the difference. This means it isn't a sunken cost like the permanent buydown, something you can benefit from. I'll expand on this and the pros on this a little bit later. Now let's take our scenario we used for the permanent buydown and structure it as a 2-1 buydown. Same $350,000 home, same 5% down payment on a 30-year fixed rate mortgage at 6.75%. Year 1, you'd be at 4.75% with a principal and interest payment of $1,735, a savings of $421 per month, over $5,000 the first year in savings alone. Now year 2, the rate will be 5.75%. saving you another $216 a month and another $2,500 in year 2 of savings. Sounds great, right? But who pays for it? In most cases, the seller will pay for this, but the lender can also contribute. Obviously, you can't pay for this because you'd simply be prepaying out of your pocket what you're already responsible for. So let's talk about what the pros and cons of the 2-1 buydown are. While there's no one-size-fits-all in mortgage, it's important to consider both the pros and the cons when looking at the mortgage options. Starting with the pros, the most obvious is the amount of savings up front. This helps homeowners ease into a new mortgage and become acclimated. The biggest cost of a new home are incurred in the beginning. Moving costs, upgrades, renovation, blinds, fencing, that list can go on and on. It all adds up, and having a lower monthly mortgage helps you better budget for it. 2, it's just a really good use of money in general when you look at the monthly savings versus a permanent option. Third pro is that the seller's paying for it. But the biggest pro, I believe, is one that most don't know about, and that is that the fees for this program are partially refundable. Remember when we talked about the permanent buy down being a sunken cost? Well, with the temporary buy down, if you refinance or sell the home within the buy down period, any funds left in the subsidy account are refunded to you and applied to the principal payoff of the home, which means theoretically, the overall cost of your new home could be less than what you originally bought it for. So, need an example. Let's say rates drop and you see an opportunity to refinance at the end of year one of our scenario we've been using. This means the $2,500 left in your subsidy account drops your payoff on your home by $2,500. Now just imagine if rates came down fast enough to refinance after 6 months or so. Now, nothing's perfect, so let's talk about the cons. Number one, and the biggest, is that this is only temporary. This means that if rates don't drop, you will eventually be responsible for that higher rate. Your lender will actually qualify you off of that higher rate when they're in underwriting. And it's also important that you budget for it as well when making your decision. The second con is that you have to have a seller that's willing to pay for this. However, there are some willing parties out there. Also, this really still doesn't solve any affordability issues. As I said, we're going to qualify you in underwriting at the higher rate, so you're not going to be able to afford more home per se. So is a temporary buy down for you? Maybe, maybe not. I believe this is a great program when used correctly. My advice, work with a mortgage professional who's going to show you all the options along with the overall cost of each, both short-term and long-term. So are you just beginning your home journey? I've left a link below to our home buyer planning kit that you can download and use to help you craft the perfect home buying experience. And of course, I'd love the opportunity to work with you on your mortgage needs. You can reach me at the contact info on the screen. Make sure while you're here that you like, subscribe, and comment so you'll become part of our community. We value people like you, and we want to be able to help in any capacity we can. So until the next video, happy house hunting. I'm Adam Black, your lender for your life, and thanks for stopping by.